My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Matthew Klein, who's got a really interesting background and has a lot to talk about when it comes to class warfare and the widening wealth gap that we're seeing everywhere. Matthew, for those who are not familiar with your background, introduce yourself. Who are you? What's your educational background, and why did you focus on the increasing dynamic of class war across the globe here?
Well, thanks very much for having me on the show, Michael. So my background, I now am the founder and publisher of a subscription research service called The Overshoot. And before that, I also, as you mentioned, I co-authored the book Trade Wars or Class Wars with Michael Pettis, came out a couple of years ago. Before that, I was the economics commentator at Barron's. I've also written for the Financial Times, Bloomberg, The Economist. And before journalism, I was an investment associate at Bridgewater, and I had the chance to be a research assistant for a couple of years working with Sebastian Mallaby on his biography of Alan Greenspan, which I definitely recommend. It's called The Man Who Knew. I studied history originally, not econ or finance, but I was fortunate enough that, when I was looking for jobs and internships, that some places thought, well, whatever you learn in college is going to be incrementally useless to us compared to what we already know. So we're just looking for people who might seem like they could learn things, and ended up getting into becoming an intern at Bridgewater in the summer of 2008, which is a really fascinating time to be getting an introduction to global markets. And I just got absolutely hooked. I thought, this stuff is just absolutely fascinating. I really need to understand it. It affects everybody in the world, whether or not you are aware of it. And it's just really set of interesting and important puzzles to sort of wrap your head around and how to really explain so much of what's going on in the world. And that's sort of the beginning of that. And, eventually realizing that I wanted to be in a more kind of public-facing role and explaining these ideas to other people and trying to communicate and hopefully improve the way policy works. In terms of the question about class conflict, it's kind of funny because a lot of the Michael Pettis, I was introduced to his work many years ago, and when it's interesting because it can, if you're not paying attention to stuff about different sectors of the economy have different savings rates, and that affects how much they're willing to spend or invest or things like that, and it can seem very dry, but you can break it down and you realize what it's actually talking about, and it kind of really sort of profound implications about what the consequences can be of changing the distribution of income and why things that happened in the past few decades have had the impact they had and leading to all sorts of financial crises and booms and busts and deindustrialization and all the political turmoil we've experienced across the rich world. And that's really why, we wanted to write the book that we did.
So speaking about Bridgewater, Ray Dalio's claim to fame, I think you can argue, was largely risk parity as a concept. And I've made this point before that had Ray Dalio maybe started risk parity 2 years ago, he probably would not be a billionaire 10 years from now, given the way risk parity played out this year. The kind of abnormal behavior of markets where treasuries really just didn't act as the counter, right, to markets. I think it's the worst year in history for risk parity, even from a back perspective.
I mean, I don't know if I would say that's right. There definitely are periods of time when risk assets in general are not going to do well, and this has definitely been one of those times.
Right, and I want to relate to what you said earlier about you have to study history and be aware of history. The thing with history is that we don't really know if the sample size is large enough when studying history to come up with a conclusion. So, as you wrote the book and as you did the research behind the history of class warfare, is it one of those dynamics where it's something that's a constant because it's part of human nature that the elites get more powerful and everybody else kind of gets left behind? Or is it maybe just as simple of a statistical answer as to say that that's been the case before, but that's not necessarily the case going forward?
Oh, yeah. I think that the pattern of how these balances work out in terms of, who's in charge and who's taking more from others, that always is going to be changing. And that's why it's really helpful to kind of dig into the specific situations, specific cases, which is what we tried to do. So we spent a lot of time in the book really focusing on what actually happened in China, in Germany, in Europe, what happened in the United States, because all of those circumstances are going to be different. Any country you look at, there's always going to be variation. But what is interesting is that despite that, the relationship between these sort of political economy changes, these social changes, and how those translate into economic outcomes and macro and financial outcomes, those relationships actually are remarkably stable over time. And that's what's interesting, and that's why it's helpful to have that kind of perspective and say, we have a section in the book where we're talking about the Franco-Prussian War, which is 150 years ago, and how after the war is over, the German Empire puts this huge debt burden on France. So you have to pay us back an indemnity for the cost of the war and give us basically a prize, because we won. And if you don't give it back in this period of time, we're going to occupy all of northern France, and which is a lot of where French, industry was at the time, and a lot of their food was grown. And it turns out that the French government was able to raise the money remarkably quickly, pay off the debt very quickly. The money goes into Germany, and then it leads to this huge bubble in Germany. As they get all this money, it turns out they don't actually know what to do with it. And you can very clearly see that even though the political circumstances, the economic circumstances, a lot of things were very different 150 years ago than now, if you look at the mechanics of what happened, it's very relatable. And you can really see very clearly how, what the similarities are to the kinds of financial cycles we see of money going out from advanced economies into what looks like exciting, frontier markets or whatever. And then it seems like it creates a boom, and then money doesn't go in projects that turn out to be worthwhile, and you have a huge bust. And I mean, these dynamics are very similar across time and space. And that's, I think, what's really interesting to have this kind of context when you're looking at what's going on in the world today.
Is it fair to say that the primary, let's call it weapon, for lack of a better way of saying it, that it creates the widening wealth gap is ultimately inflation? I mean, that really is what causes the middle class to no longer exist, whether it's in the U.S. or anywhere else in the world?
I don't think so, actually. I mean, that can be the case, but it really depends. So if we look at say like 1989 to say 2019, which is the bulk of where we spend on the book, that was a period when inflation was not really an issue in most parts of the world, certainly not in the rich countries. And so it can be the case that you have inflation leading to really dramatic redistribution. That's why people don't like inflation, because all of a sudden it just seems unfair, right? Because it's not even. It's not as if every price and every goes up by the same amount proportionally. There's very large changes often in relative prices, and people think, well, it's not really fair. Someone got a lot better off than I did, and that's why people don't like inflation. That's why inflation is a problem. But you can have a lot of other things that happen that don't involve inflation. So for example, in the German case, what happened was basically you just had a period of long economic stagnation where businesses just decided they weren't going to invest in Germany. They would lay off a ton of workers in Germany. The unionization rate in Germany collapsed. A lot of jobs got shipped to Central and Eastern Europe. The government then responded by saying, well, we can't afford to pay out benefits to people who are retired. So we're basically going to cut the welfare rolls and force all these people who'd retired or, early, so like age 60 or something, find some kind of low paid part-time job. All of a sudden they switch from getting government benefits, doing nothing, to doing something that's relatively low value, and then paying in taxes in the social security system. And the net effect of that was to really squeeze kind of the middle and lower classes within Germany. But that was in the context of essentially no inflation. So you definitely can have inflation being an issue. The China case in the book we talk about, in the 80s in China, they actually did have some severe inflation problems in temporary waves, because you have a situation where, before 1978, you have a not quite centrally planned economy in the sense that like there was some organizing in the center. Everything was planned. There was provincial objectives and so forth, but it was not a market economy by any means. But then after 78, you have a lot of liberalization of prices in the countryside, which is where most Chinese people lived at the time. You didn't have kind of a commensurate change in prices in regulation of prices in the cities. And because up until 78, the peasants had been squeezed by the government, this is sort of the classic communist model of you squeeze the peasantry to support industrialization very violently, as it happened in China, as happened in the Soviet Union under Stalin. Undoing that meant that food prices went up a lot relative to industrial good prices. So people in the city felt like they were getting squeezed. And so you saw these set of protests, especially in the second half of the 80s, against rising food prices. And that was very destabilizing, and that sort of threatened, middle class isn't really necessarily the right word, because there was just so few of these people within China at the time. But, the sort of urban industrial class getting really squeezed. You had protests in 87 related to that. Part of the motivation, certainly not the only part, but part of the motivation for the protests you saw in 89 was also related to the spike in food prices. So definitely that can be an issue. In that case, it was you needed to have food prices going up because the farmers had been getting squeezed so badly before. But, obviously anytime you have a big change in relative prices, people on the losing side are going to be very unhappy about that.
Make the connection for the audience around trade wars, tariffs, and how that widens the wealth gap. Because, I don't want to get this political, but you go back to the tariffs that Trump had put in place, and really any kind of president, I think one of the arguments that's always put out there is that it's done for the interest of the American worker. And it turns out that the American worker may not be benefiting as much as the narrative would have you believe.
Yeah. So I guess a couple of things. One is that, and this is a point that I hope people reading the book will come away with, is that a lot of what we think of as trade policy is not that important for trade compared to a lot of other things that we don't think of as trade policy. So tariffs definitely have an impact. How you negotiate a trade deal has an impact. But compared to other things, such as what proportion, how are workers paid relative to, what company corporate profits? So what's the profit labor split? That is going to be a much more important thing. And that's not something that obviously shows up as a trade policy, or in the case of China, right? Notorious for not having labor protections, or unions being adversarial unions are not legal, or you have all sorts of environmental rules that are very much in favor of businesses that might pollute, but not not very good to the people who live in the country. And so those things may not seem like trade policy, but they can have a huge impact. And so when we talk about the class war element, the point that we try to make is that what looks like a class war, or in fact, what is a class war domestically within a given society, can have all sorts of side effects and negative consequences for people outside that country. And that can spill over in a trade. It looks like a trade conflict. And so the sort of most obvious example we talk about in the book is it looks like you could say that China and the US were having a trade conflict, or some kind of economic conflict over the past 3 decades or so. And that Chinese, as we had more trade with China, especially after China enters the World Trade Organization, that you have this big influx of Chinese imports, that these displace American manufacturing jobs. All these people lose their jobs and they go into debt, and you have the deaths of despair and social collapse in significant parts of the country. And you say, oh, well, that's like the Chinese workers took American jobs. But that's not actually quite the right way of thinking about it. The point we want to make in the book is that those things all happened, but the actual causal trigger wasn't the China trade with the US. The causal trigger is that Chinese society, the political economy within China, was such that as China became a larger part of the global economy, it ended up distorting the global trading system. And there were negative consequences for Americans. That many Chinese people also lost out. That essentially, over this period, you saw a major transfer of wealth and income within China from workers, from ordinary consumers towards elites, whether it's, sort of party connected, provincial politicians, or whether it's business elites, or whether in fact it's people who own manufacturing enterprises in China that are foreign multinationals. So obviously a lot of American and European, Japanese companies invested in China, and were very happy to invest there because the Chinese government basically guaranteed them relatively high profit rates. And so the result is that there was a trade conflict, there was a class conflict, but really the thing is that you had the bulk of Chinese people losing out internally within China. You had a lot of people losing out in the United States, people winning in both the United States and in China. And so it's not really right to think of this as a national conflict between China and the United States that, shows up in terms of trade. It's really, you should think about it as this class conflict, that the symptoms of it show up in terms of these trade imbalances. And that's a big part of the argument of the book.
I don't think you can talk about trade imbalances unless you also talk about, or trade wars, unless you obviously talk about currency wars, right? And currency
Absolutely.
wars, right? And that also relates to interest rate differential wars, right? that happen across countries.
Yeah.
So let's talk about that in the context of this year in particular, because we're related to the Bank of Japan this week, but there's a hell of a lot of bloodied currencies relative to the dollar this year. I'm just curious. I mean, what's your sense of how central banks and policymakers are responding or thinking about the dollar's strength? Because that does, you can argue, also really factor into widening wealth gaps domestically.
Yeah, it's a really interesting question, because I mean, the thing that people had been complaining about was saying, the phrase currency war, I think, entered the popular lexicon, I think, in 2010, or when I think it was the Brazilian finance minister was saying that because of the Fed, when the Federal Reserve was buying, I think it was under QE2 or whatever, buying bonds, that the idea that this would weaken the dollar and it was a currency war and we were going to gain some unfair competitive advantage in the US, which, by the way, is not actually what happened. The dollar did not depreciate meaningfully in that period. In fact, it just went up, ever since. But the original concern was that the cheap currency would give some kind of competitive advantage by supporting domestic producers over foreign ones. And that was sort of trade. And that's a guy very consistent with sort of this trade conflict frame. And what you're talking about now is the opposite. And so people are saying, oh, well, the dollar is too strong and it's making it too, every other currency is falling and that's really bad for us too. And so the first thing I would just say is, like, these are not consistent complaints. Like, you can pick one, but it doesn't seem right to say that they're both problems. I think that having been said, like, major changes in your exchange rate one or the other can be really disruptive in either direction. And currency, I think, has been one of the points we mentioned in the book, and I think it's still relevant, is that when the currency appreciates, what that means is that your domestic purchasing power will go, or your international purchasing power goes up. So everything outside of your country is going to be relatively cheaper. Everything that you produce in your country is going to be relatively more expensive than everyone else. And that can be good or bad depending, and benefiting depending on who you are and depending upon your economic circumstances. So if you're someone who mostly imports, you don't work in an export facing industry, you're a typical consumer, and you're in a situation where inflation is a problem, then an appreciating currency is very helpful for you because it makes things that you would buy from abroad cheaper. And you're no skin off your nose if your exports are less competitive because you're not an exporter, right? If that's one way of looking at it. The other way of looking at it is depending on, you can have another situation where, let's say, the global economy is not doing well. You're coming out of a financial crisis and things are no one is really spending as much as they should. Factories are all being underutilized. You have a lot of unemployment. And you can say, well, in that case, if there's a shortfall of global spending, then you want to have as much for yourself as possible, especially if you're in a business that does compete with businesses in other countries. And so having a currency depreciating is going to be very helpful to you because, your imports will be more expensive, but on the other hand, you'll be able to make more money from your exports and you'll have less worry about competition from abroad. And so that, benefits you. But every society is a mix of all these different kinds of people. So whether a currency appreciating or depreciating is good or bad, and it really is contingent on who you are within the society and what are the specific economic circumstances facing. And so that, I think, is a really important context whenever we're looking at these kind of questions.
I'm just thinking out loud, but I'm going to assume that just from an incentive perspective, the very wealthy, the in quotes elite, would probably prefer a weaker currency because they are probably most likely to have the resources in place to have businesses that benefit from exports and global activity.
Maybe. I think it really depends on the country. So, I mean, in the US, I feel like it's actually kind of the other way around because the US, that probably would have been true maybe 50 years ago, but for better or worse, the transformation that occurred in the US really since like the 1980s, I think is actually come the other way. I think the reason why you had this sort of long succession of people across parties of saying strong dollar is what we want. I'm talking like treasury secretary, that kind of thing. And there, a lot of whom came from positions in the financial sector. I think it's actually within the US different. I think if you were to look at a country like Germany, it's probably the other way around, or Japan or whatever, different kinds of societies, the different political economy. I think it depends. But I think in the US for whatever reason, I think in many cases, the people who, I don't think it's as simple as like the very rich, like an expensive dollar and everyone else like the weaker dollar. But I think that if you were to look at the preference of the very rich, it's probably that an expensive dollar is more valuable because then you can buy assets abroad more cheaply. You're not necessarily in a sector where you really care about export price. I mean, if you're Google or something, right? The money you make is not going to be, you're not competing with a foreign company and you're going to compete on the exchange rate. I mean, that's not how your business works. And so, or if you're an investment bank or something. And so I think that those kinds of companies, it's probably a very different kind of dynamic compared to if you're a manufacturer that's exporting a lot, which in the US, I mean, there are certainly companies that are in that kind of situation. I mean, Boeing is kind of like a very obvious example, but a lot of those other, and even then though, because it's such a consolidated market globally, I'm not even sure then how much it would matter. But other countries, it probably does make much of a difference in, the profitability. So I think it's tricky to say like, what are the preferences of one or the other? I think it seems to have been the case, and this has sort of been convenient for their collective interest globally, that elites in the US and elites in, say, China have both benefited from a relatively expensive dollar relative to the Chinese yuan, for example. I think there's been a complementary interest there of elites in both countries. Not necessarily good for consumers in either country, or ordinary workers, I should say, in either country, but that's sort of, I think, been a consensus there. And that, as an example, I think other kind of currency pairs, other societies, maybe it depends, but I think that seems to have been the case for a while in that context.
Yeah, no, and actually, as you say, that makes a lot more sense. It's kind of like it's a cheaper way to diversify globally with a stronger currency. So the elites would want that just to spread out the wealth in all kinds of different places. I think that does make intuitive sense. Let's get some of the audience up here. And again, anybody wants to ask questions, click bottom left.
So that's a great question. It's something we do try to talk about a bit towards the end of the book. And I think one thing that's really important to remember when thinking about this is that the dollar is a reserve currency, or is used as a reserve currency, because people outside the United States think that is good for them. But this is not something that is imposed, for better or worse, by Americans. And so the question then becomes, why is that? And I think the reason for this, and this is not unique to the dollar, if you look sort of relative to the size of their economies, you also see this disproportion for like the UK and Canada, Australia, even New Zealand, right? I mean, they're just much smaller economies, but you see sort of a similar proportion of foreign interest. And I think the thing that you have in common is that they're very open financial systems. So basically anyone from anywhere in the world can put money in. There are not a lot of restrictions on how you can get money in or get money out, for that matter. The legal system is very strong and very investor friendly. People know how it works. and it's in English. So, there's not really a lot of barriers to entry for if you're a rich person in the world, you probably either know English or know someone who knows English. And so that means that you're going to have a lot of money coming into these societies. If people are looking for a place to put money, they have extra. It seems like a good place to put them. Whereas you look at a lot of other places, there are a lot of limitations, either as a linguistic limitations or the financial system doesn't really create assets flexibly enough for you to, put something in, or you don't necessarily have the investor protections. You look at China, for example. It was only relatively recently that foreign investors could buy Chinese bonds. The Bond Connect, I think it goes with like 2017, 2018 is when they sort of started that. And, up until, if you couldn't do that, that sort of doesn't make it very compelling as a place to, hold reserve assets. If you're someone outside of China, if you can't even get money into the country and hold fixed income until a couple of years ago. And then, of course, there's a question of, well, there are a lot of financial capital controls there. How confident would you be you can get money out if you really needed it? So there are things, and it's not just China. There are a lot of other societies. I think Europe actually would be the most obvious alternative currency, and that was when the euro was being pitched as a product, or not product, as an idea or whatever. The sort of early 1990s, as this, one of the ideas was like, oh well, it would be as the economic bloc would be comparable in size to the U.S. So this, if we have kind of a state, we're also like an advanced rich society with good legal system ostensibly and whatever, and yet it never really took off in the same way because of the fragmentation. So it's not as if there's one single European government bond, one kind of common European deposit insurance. Everything is still very fragmented on national lines. So that never took off. And that would have been the most obvious alternative. The other thing I would say is that while you're absolutely right, that foreign demand for US assets and as a Canadian assets, British assets, et cetera, relatively speaking, inflates the purchasing power of consumers in those countries. And so you could say that we're living beyond what we otherwise be able to do. There is a cost associated with it, which is that we have to have a financial system producing assets for other people to buy. And so that means that we end up taking out a lot more debt than we otherwise would. And the problem there, the potential problem, is that if we didn't need to take out the debt for whatever reason, then essentially we're in a situation where we're basically producing less at home to buy more made abroad and taking out debt, to cover the difference, when there's an alternative scenario where we would have produced more at home, bought less from abroad, and borrowed less. And so, therefore, for me to say, I therefore have a tough time saying like we're definitely better off from the world we've actually inhabited, and that therefore, if that were to break down for whatever reason, that we'd be worse off. I think obviously any kind of sudden transition is always going to be disruptive, regardless of what it is. But it's not obvious to me that it's a situation where the U.S. would be a lot worse off. In terms of a specific example of the BRICS countries, I think one potential challenge is how would you have a balanced trading system with each other in terms of how would that work if you're all talking about countries with very large trade surpluses, current account surpluses? Where are they going to be? And that is possible that they can all have these very large surpluses because there's someone else on their side that is borrowing, that is having a deficit, and that is have a financial system that is willing to accommodate those surpluses. That is the Anglosphere, basically. And so if you want to create a different system that doesn't involve sending trillions of dollars into the Anglosphere financial systems, you can't have the trade surpluses in the same way. I mean, Saudi Arabia getting paid in yuan, I mean, that's great, but then what are they going to do with their extra yuan? Put it back into China, and then they can't buy the things they want. I mean, because Saudi Arabia has a big trade surplus with China. China has a big surplus with the U.S. Russia has a big trade surplus with China. I mean, there has to have these things all have to add up one way or the other. And I think that's one of the reasons we haven't seen the reason why the system that everyone says is suboptimal and doesn't make sense and it's geopolitically bizarre. The reason it keeps persisting despite all that is because all the alternatives seem even harder, less workable. Yeah, I haven't heard that. I mean, I have to think through more of the mechanics. I'll be honest, that sounds a little tricky. I mean, essentially, it sounds like they're basically saying they would charge a higher price for their oil than what other people would charge, and I don't know how sustainable. I mean, right now they're charging much less than the market, than like the global oil price because of constraints on who's able to buy it and what. So I don't know how they'd be able to convince people to pay a lot more. But as I said, I probably have to think more through all the mechanics of what you're saying to really give you a thorough answer. But it doesn't seem obvious to me, to be honest. Like the currency in which you denominate the price of something is not as important as who is able to buy it, what they're willing to pay, and that kind of thing. And of course, Russia right now has a lot of constraints on their ability to accept money because of the and use money they get because of the sanctions. So that makes it that's sort of another complicating factor.
Have trade imbalances, I guess, gotten more accentuated because everything's largely essentially a fiat-based way of conducting trade? How did these kind of dynamics around trade imbalances work pre 1971? Was there less of a spread between the very elite and wealthy and everybody else, and the trade wars were not as effective at widening that spread? How does that factor in?
Yes, that's a good question. I think the short answer is yes. I think that the move away from I mean, 71 is sort of an interesting point. I think arguably like the pre, like you have to go back to like the classical gold standard to really see how this would work. Because the way it was supposed to work originally, or it did work, sort of pre 1914, was that you had a very clear connection between domestic financial conditions and international balance of payments. And the connection was that all domestic banking systems were based on gold in some way. I mean, there was, people did have fiat currency in the sense that banks could expand credit beyond gold. Like it wasn't sort of fixed ratios, but there was still that kind of gold anchor. And at the same time, when you had international balance of payments, if a country had a current account deficit, then that corresponded to an outflow of gold. And what that meant was that as gold was leaving the domestic financial system, that either tightened financial conditions or led to a situation where you'd have a financial crisis, which would really tighten financial conditions. And the flip side being, if you have a surplus, trade current account surplus, gold would be coming in, which would be loosening financial conditions and leading to inflation and more credit extension. And so the idea is that would be sort of self-correcting, because if you have a trade surplus, but then you have this huge boom, credit boom, then that's going to be leading to more imports because people have more money, and it's going to be leading to prices going up more because you have wage inflation and price inflation, all that stuff. And so that would naturally put downward pressure on a trade surplus. And then the flip side, this is the counterbalance here, is that if you were a deficit economy, then financial conditions would be tightening. People would be forced to spend less. That would put downward pressure on demand for imports. And if you had a financial crisis, a really extreme case, it'd probably lead to deflation. Again, that would sort of change the relative prices and so leading to balance. And so what that meant was that this wasn't necessarily a great system for a lot of other reasons, but one thing it did do is it sort of put a pretty effective cap on how big deficits and surpluses could go. These imbalances were, in the absolute value of these imbalances, could not get that large because of these very clear link between the international balance of payments and the domestic conditions. This was supposed to be replicated after World War I, when people went back to the gold standard, but it didn't happen. And it didn't happen for the main reason being was because the US and France realized that if this were going to happen, that they would have a lot of inflation, and the central banks there basically decided to do inflation targeting. And what that meant was all the gold that was coming in was not actually getting to the domestic financial system. It was not leading to commensurate credit expansion and price increases that would have happened in the old system. And so you ended up having this shortfall of spending and inflation. And so it was, if you were in the US, it seemed great. But if you were in the rest of the world, it was horrible. And you had this essentially sort of situation where you were forced to take on more debt. You had essentially a Great Depression showed up early in the UK. Germany was all, sort of teetering after World War I because of all these dynamics. And so it was a real problem. And, what happened after the war was they didn't recreate the gold standard, but they did try to have, again, these kind of limits on what the flows could be. Their capital controls are put in place. Lots of, exchange rates couldn't really adjust, but the idea was that the IMF would regulate imbalances and force exchange rate adjustments. The idea being that, well, if you're running a persistent trade deficit, then obviously your prices are out of line. So you have to have your currency depreciate. So your prices, your prices for the rest of the world will go down. The prices of foreign things will go up, and that will help rebalance. And that was sort of supposed to be how it would work. And it didn't really work very well. I mean, we have the breakdown in 71 because essentially the US was in a situation where, even though the US actually traded surpluses for most of this time, you had actually even more financial outflows. So we had a trade surplus that you would have expected that lead to investment abroad, but there was even more investment abroad than the trade surplus. And so the corollary was that there was an outflow of gold from the US. Originally, it was just we were printing dollars to give to Europeans, and they said, no, we want gold. And then we said, we're going to run out of gold, so you can't have any. And then that was why it broke down. And then you break down in 71, and then there are no more limits anymore. And now it's a question of just, are creditors willing? The linkage between domestic financial conditions and international balance of payments, it's not completely broken, but it becomes so much more attenuated, so much looser that you can have much larger imbalances after 71 and really after, starting getting the 1980s, 1990s than you ever had before. The creation of the euro, I think, is another really good example of this, where, European countries, they were relatively limited in how the imbalances they could have up until the creation of the euro. But then all of a sudden people say, oh, well, people naively thought, well, there's no default risk because these are all rich countries and rich countries don't default. And there's no currency risk. So we can just have massive cross-border flows. Like, and the optimistic view is like, we don't look at the balance of payments between, New York and New Jersey, and so therefore we don't need to look at between France and Spain or whatever. But actually, it turns out there's important differences between New York, New Jersey on one hand, and France and Spain on the other. And so that, again, led to these huge balances showing up, which I think, as you said, it's all tied to sort of the unanchoring from any sort of hard constraint, whether it's gold or what any other kind of limit you could have put in place.
Everybody, please make sure you follow Matthew Klein and check out the Overshoot. I'm sharing it with an S. We're going to talk about some of the writings he put up there shortly. Again, my name is Michael Guide. If any of you want to come up, click that bottom left mic request button. So I love the name, the Overshoot, because I feel like I always make this point. It's whenever you invest in anything, you're inherently really only answering one question: has the current price overshot or undershot against all available information? All right, it tells me about overreaction, underreaction. And this week, you had a pretty interesting reaction by the market and by bonds in particular, and really treasuries, to what the Bank of Japan did. Lay out for the audience what happened this week with BOJ, if it was really a surprise and if it's really just a nothing burger or not.
Yeah, so I'll be honest, my interpretation here seems to be the minority view. So, take that for what you will. But the Bank of Japan, since 2016, had said we are going to target the level of the 10-year Japanese government bond yield, and we're going to let it trade within a band. And up until this past Tuesday, the target was 0% on the bond yield, and the band was going to be quarter percentage point either direction, 25 basis points. And what they changed, and the reason they targeted at 0 is because the short rate is targeted at negative 0.1. So they wanted a positive spread so that banks wouldn't lose all their money. And what they changed was they widened the trading band from, instead of plus minus 25 basis points to plus minus 50 basis points. And what happened as a result was that suddenly the 10-year JGB yield went from 24 basis points down to almost 50. It basically went to the top very quickly. And interestingly, you had pretty comparable moves in other bond yields, including in treasuries and stuff, where it's not obvious why that would be a connection. And so then the question is, was this a policy change, or are they trying to exit? The Bank of Japan has long been kind of doing its own thing because economic conditions in Japan are so different from the rest of the world. Are they finally getting worried about inflation the way everyone else is? They're going to start tightening policy. That's the question. A lot of people seem to think the answer is yes. That's why the yen went up. That's why other bond yields moved. My interpretation is no, and I kind of base this on a couple of things. One is that they very clearly said when they did it, they're trying to essentially solve a problem with the shape of the Japanese yield curve, that because they were focused so clearly on the 10-year yield, but not other yields, that 8 and 9-year yields had actually gone above the 10-year yield. It created this weird kink, and so there wasn't a lot of trading. They do the survey every quarter of market makers, and they're saying market functioning in Japanese government bonds has gotten really bad recently. And what they've said is this could affect the corporate financing environment, that people who, the extent that these are reference rates for corporate bonds, we don't want to have any issues where CFOs of Japanese companies don't issue what they would want to do because of problems with the Japanese yield curve. So we're going to just do this tweak, and it's going to change it. And then they also said, we want to make sure that we're improving the transmission of monetary easing. It's not facilitating the easing that they're trying to do. And they said, we're going to actually increase the amount of bonds we're going to buy from 7.3 trillion yen a month to 9 trillion yen a month. And so they say all these things, okay, well, that sounds like a pretty reasonable explanation. The other thing that's interesting too, and I think is you can interpret this a couple different ways, but if you look at Japanese bond yields further ahead from 10 years, they've been going up a lot already. They didn't go up at all in response to this announcement. If you kind of look at forward rates, you say okay, what's the 5-year Japanese bond yield starting 10 years from now? That actually went down. I mean, not a lot, but it went down. The further ahead yields were basically flat or slightly down. So and shorter end rates, basically from 0 to 5, were flat. And so that to me basically looks like a situation where, okay, you had there was this weird issue for the 5 to 10 year range, more or less. They fixed that. A lot of people had a very strong reaction to it. But if you listen to what they're saying, and again, maybe I'm going to get totally embarrassed because they were actually just lying, but what they're saying is, we actually want more inflation. We haven't had inflation in 30 years. We would like to see some wage increases. We think that maybe if we can keep up the inflation that we've had recently, that will eventually convince businesses to start raising wages. They're in such a different dynamic than the rest. I mean, the rest of the central banks, they're saying, we want to prevent expectations from changing. So that's why we're tightening policy, even if, we think we're going to send our economies into a recession. Bank of Japan is no, we want to change it. We do want to change expectations. We're going to keep going. They call it a virtuous circle. And so that's why happen to be of the view that they're not, there wasn't a fundamental shift. I mean, I said, maybe I'm totally misreading it, but I think we should take them at their word here. It makes a lot of sense based on what they've said and based, what they've been doing for the past, 10 years. And that's kind of my view on Japan right now.
Yeah, and by the way, I'm with you on that point about it. I can't wrap my head around why the reaction by U.S. Treasury yields would be as violent as we saw, just because of what they did. I mean, is there anything that you can think of that would even from a currency or expectations perspective that might explain why you had our yields in the U.S. rise, pretty
Yeah.
aggressively?
I mean, I think from sort of positioning, which is where it gets, I think you could imagine a situation where Japanese investors who already have been kind of running down some of their dollar assets might have thought this was a good chance to do more of that and basically switch from, U.S. Treasuries to JGBs or something like that. And that would have had that impact. I don't think that sort of, and that would suggest, I mean, it's not, because like clearly what the Bank of Japan does is not going to have a kind of deep impact it shouldn't have on like U.S. financial conditions or U.S. monetary policy. But you could have the situation because there is Japanese, life insurance companies and pension stuff. They own a lot of bonds, corporate bonds and treasury bonds. And to the extent that they're already kind of moving away from that, because they own a lot of them on a hedge basis. And so what that really means is like, oh yeah, U.S. Treasury bond is such a higher yield than a JGB, but because of the hedging, like really what they're looking at is like the relative slopes of the curves. And now that the U.S. curve, because they're basically paying like the 3-month rate or whatever, the hedging. And so now that the U.S. curve is so inverted, Japanese curve is still positively sloped. And in fact, it's more positive slope now because of this change. Like it suddenly becomes more attractive from from the perspective of a hedge Japanese investor to be holding Japanese bonds than treasuries. And so you can see why you can see why they had been moving out of treasuries, and you can see why they might have done more so. But again, that doesn't really mean anything about like their tightening policy or anything like that. Just like you're an investor trying to maximize return and you're looking at relative yield curve slopes.
I have not looked at the velocity of money in Japan, but I'm going to assume it's pretty poor. And I say that because, as I understand it, a lot of Japan is characterized by savers. So
Yeah.
higher rates presumably would even encourage more saving. So yes, they want inflation, but if that causes an even deeper drop in the velocity of money, then that inflation is not going to last long anyway, I think.
Yeah, well, so Japan's a really interesting case, and this is one of those things like we talked about a little bit in the book, and I kind of wish we'd had more space, but it's as its own example. But what's really interesting about Japan is you go back, 30, 40 years, and it's absolutely true that Japanese households, like Japanese people as individuals, saved a ton of money. They were very conservative that way, and you could attribute if you were to look, someone was like, oh, like the reason Japan like has this kind of economic behavior at the macro level is because Japanese household saving rates are very high. But that hasn't been true actually for a long time. The reason, basically, since the early 1990s, you've actually had a big decline in the savings rate. And before the pandemic, the savings rate in Japan was close to zero, the household savings rate, because you have population aging and old people aren't working. They're running down their saving, right? So even if people who are working might have high savings rates, the net effect was actually very, very low savings rate compared to, say, the US, for example. The thing that's different is that Japanese businesses were extremely conservative. And if you want to look at sort of the big picture, like what changed Japan and what, in fact, the sort of Abenomics program was trying to fix, was the fact that Japanese businesses, up until about 1990, were very aggressive at borrowing and investing. And in the Japanese economy, and also sometimes outside of the Japanese economy, buying Pebble Beach or whatever, but like a lot of it was like in the Japanese economy. And after 1990, you have this huge swing. They go from you think about the sort of the Japanese businesses' contribution to the current account deficit, or everyone, their financial deficit of relative to Japanese GDP was about 10% of GDP in 1989. And that swings to a surplus by the time you get to sort of the mid 1990s or whatever, of like almost, I think, plus 5% of GDP. I mean, it's a huge move. So like, 15 percentage point swing or something in the behavior of Japanese companies, basically coming from the fact they just stop investing domestically. It's not that Japanese corporate profits go off a cliff. It's that they stop investing domestically and they switch from borrowing to invest to paying down debt very aggressively. And it's been the situation they've been in for almost 30 years. And Abe comes into power at the end of 2012. And this has been a persistent problem. I mean, it's not his predecessors tried to deal with it. And his idea, and this is also Kuroda Haruhiko's idea, which is his Bank of Japan, is sort of the consensus among this group of people, was you needed to compel and encourage Japanese companies to stop hoarding, stop retaining earnings, stop accumulating cash in the balance sheet, stop paying off debt, and spend money, pay workers more, invest, do all that good stuff, pay dividends, any of those things. And the solution they came up with was sort of this the 3 arrows that Abe had. An important part of it was the reflation agenda. The idea, you talk to people who are affiliated with this, at least, I don't know if this is ever publicly said, but at least off the record, they're like, yeah, you have inflation, suddenly hoarding cash is not going to look as appealing. It's like basically a tax. And suddenly, you want to have them put their money to work. That's part of it, right? That's not the only reason, but that was part of the whole agenda. It didn't really work. If you look at what happened with Japanese corporate behavior since Abe, I mean, they did increase their dividend payout ratio, but otherwise, Japanese corporate saving still was very, very high after that whole period. But, the extent that we're having inflation now and the extent that Japanese companies are not yet, I mean, they're eating the cost for the most part. I mean, that's what's really striking. Inflation in Japan is low, even though Japanese input prices are going up a ton, just like they are everywhere else, or have been going up a lot, just like everywhere else. And so that's showing up in the form of weaker margins. They haven't really been raising wages yet. So the hope that I think that the hope of the Japanese policymaking, or at least this part of the Japanese policymaking establishment, is that that's going to change, and that actually, finally, the companies will switch from hoarding to spending. They'll pay workers more because even if it seems inflation, they'll raise prices, and that this has this fundamental change in mindset. And they want that. They said they call this the virtuous circle. That's what the Bank of Japan calls it. It hasn't happened yet, but I mean, I think that's why they have such a radically different approach to monetary policy right now than everyone else. But it makes sense because they have a very different situation than everyone else does.
Again, everybody here, please make sure you follow Matthew Klein for the remaining several minutes here. If anybody wants to come up, feel free. So I'm going through your site, the overshoot.co, and I'm looking at some of your recent writings. One of the headlines is "Patience on Inflation is Paying Off, Sort of." I'm curious if you're surprised that inflation hasn't maybe fallen more aggressively. And I'm saying that because, look, I mean, the dollar's been abnormally strong. That's disinflationary. You have the fastest rate hiking cycle in history. That's disinflationary. I mean, there's been a lot of things that should have countered the high inflation. And you're seeing it obviously in goods, but not so much in services. When is that patience really going to pay off in full force, you think?
Probably, well, who knows? I mean, assuming nothing crazy happens, I would say maybe next year. But I think there are a couple of things. One is that the dollar has definitely been, I say, helpful in terms of the inflationary income, but like the U.S. doesn't actually import that much, and so the extent to which a rising dollar can have a really meaningful impact on consumer prices is not. There's only so much you can do on that front. It's not nothing, but and then on the rate hike side of things, it's very hard to say. I mean, I don't think anyone really has a perfect example of this, of like how much of what the rate hikes that have occurred have actually shown up yet in the economy, and how much of there's a lag there. I mean, I think with housing, it's been very immediate and very obvious. But for everything else, it's like not clear. I mean, the Fed doesn't really know either. They say like, well, we've had some impact. We don't really know. So there might be some lag there. I think when I made the point about the case for patience paying off, sort of, is that, a lot of the things when, it was a sort of reference to the fact that the previous year, or basically a year before I'd written that piece, I wrote a piece called The Case for Patience on Inflation. And a bunch of the arguments I made in that piece did turn out to be right. And yet at the same time, like inflation hasn't really come down as much as I would have hoped. It's kind of funny how, you can be half right, or right on some things, wrong on other things. But, on the one hand, like labor market churn has come down a lot. Like the number of people, the proportion of people quitting their jobs for a better opportunity elsewhere, which tends to be correlated to how you get much of a pay raise you get. That's come down quite a bit since the end of 2021. It's still elevated, which is kind of an important point here, but it's down by a lot. I mean, you're sort of halfway back to sort of pre-pandemic norm on that dimension. You can look at things like monthly changes in producer input prices for manufactured goods. And those have been, they had this huge increase, like multiple months in a row of like several percent increases in a month, which is huge. Now you've had it going to negative. So like that should flow through, and the goods inflation story, I think, is probably, I think we're going to probably see some more benefits because there's a lag between producers getting their input costs going down and consumers having that show up for consumers. But I think that's probably going to be a thing for a while. That'll help hold down inflation for a bit. So there are definitely those things that are really constructive as changes. On the other hand, and this is where sort of the question, like, what do you think happened with inflation? I mean, the wages have accelerated, not by a ton, but by a couple of percentage points. And the extent that people generally spend what they earn, more or less, like that is going to mean a couple more percentage points faster growth in nominal spending. And so unless there's more real production to match that, that should show up on a couple of percentage points extra inflation somewhere. Now, again, like if you were looking at what the inflation rate was, say the first half of 2022 or so the end of 2021, where on an annualized basis, we're talking like 11% on CPI. If it converges down to like 4 or 4.5, I mean, that's a huge disinflationary impulse, and that would be consistent with sort of the idea this was temporary and it's kind of fading and patience was worthwhile. On the other hand, if you're looking at it from the perspective of it used to be 2, and now it's like the underlying trend is 4 or maybe 5, and that's a problem. So it sort of depends on your point of view. Like on the one hand, going from 2 to 11 to 4 is like, okay, like most of it's gone. On the other hand, if you're saying from 2 to 4 or 5, like that's a sort of persistent problem. And so that's, I think, where it's just a question of perspective. The Fed is clearly focused on the sort of latter perspective, saying, well, we don't like it being at 4 or 5, even if it's come down from 11. And so we're going to be pretty aggressive and potentially tanking the economy to get it from this 4 or 5 underlying trend back to 2. I'm not convinced that's the right answer, but like that's, I think, where they're coming from.
How does China reopening factor into that, and also factor into what Japan's doing? I mean, the narrative that's out there is that whenever China reopens, there's going to be another massive inflation surge. I'm not so convinced, but I'm curious how you think that might complicate the timing of things.
Yeah, it's tricky because, like, I mean, what we've seen now, and I'm kind of surprised about this, to be honest, is like the reopening the way they've decided to go about it is pretty haphazard and just like a free for all. And it seems like everyone's getting sick. I know some people in China. I know people who know people in China. Like everyone's getting COVID, and it's having the impact that you would have expected happening anywhere else, where people are missing work and they're out sick, or people who don't want to get sick or trying to stay away from doing things to get themselves sick. So I don't really like in the short term, that's having a very, deflationary impact because no one's consuming. I mean, it's also having issues with production. And so that's negative. I mean, if no one can show up to work to make things. So that's in the short term, obviously very disruptive. And I don't know it could be very bad in terms of the number of people who end up dying. I don't really know what the situation is going to be there. They don't seem to be counting or publishing those numbers, but hopefully it's not going to, I hope it works out for them because, the way they've been doing things before with COVID control was extreme and not good. And obviously that's why it led to so many protests. But at the same time, they did have reason to not want a lot of people who hadn't been vaccinated properly to get sick in a country, with not a very good healthcare system. So hopefully, we only hope that it works out okay for them. I don't know. But if you look ahead at some point, I don't know when, but let's say it goes the way they would want it to, where like a bunch of people get sick, but then it kind of stops, wherever that is from now. At that point, all the sort of suppressed demand that had been holding down commodity price, particularly for oil, but also industrial metals, natural gas, that should come back, assuming the Chinese economy then recovers. I mean, that's sort of like the big if, but I think that could be. I had this sort of assumption that if they were going to roll back their COVID zero controls, that they would do it in a way that didn't get everyone sick at once. But given that, so who knows? But like you just assume they go from where they were to sort of a state like what you see in much of the rest of the world, where people are more or less behaving as normal, that would lead to a big increase in demand for fossil fuels. I mean, one of the reasons why the withdrawal of Russian supply has not been as inflationary for energy as we thought in terms of like what are oil prices now or natural gas prices now compared to say like February, January of 2022 is because Chinese demand cratered around the same time. And if Chinese demand comes back, that could be very inflationary. But there's a lot can happen between now and then. It's very hard for me to say. I mean, I think that that's still a reasonable assumption that at some point Chinese demand is going to come back, given that there has been this fundamental shift in the policy. But given the way COVID is now ravaging the population, I don't know, what kind of time frame would make sense on there, and how that affects everyone else too. I mean, to the extent people are getting sick in a way they weren't really before, that could have unexpected impacts on production of manufactured goods in a way that we haven't really seen in the past couple of years. So that's another. I think it's very hard to predict, how that's going to play out.
And maybe just for the last question, since it's appropriate given the name of the site, as you look across the entire globe and look at all these imbalances, what's the overshoot happening globally that nobody's really kind of focusing or talking about? Whether it's something short term or long term, what's a real issue from your vantage point that needs more attention?
Oh man, well I think I'm going to go. The issue that I brought up when I first launched the piece and the site and why I picked that name is I think we want to make sure that we don't lose sight of the fact that the goal is to produce more of the goods and services that we want, and that we want to have living standards rise to meet our expectations and desires. And we don't want to have a situation, and I'm concerned that we're in a situation where policymakers are going to lower their sights on what we can achieve to sort of force down our expectations or our desires to match whatever production happens to be at the time, rather than focusing on having it so that we can have a more prosperous society that produces more. And I think that we're in danger of overcorrecting, not as overshooting, but overcorrecting on that front. And the approach that we're having to inflation now, I'm concerned that rather than recognizing that a lot of the inflation we've experienced is essentially a symptom of all the real social, physical trauma we've had with the pandemic and to a lesser extent with the war in Ukraine. And instead of recognizing that and saying we want to move past that and produce more, and instead saying, no, we're just spending too much money and we're going to crush the economy to meet our sort of lowered productive capacity. And I think that would be a real tragedy and a mistake. And I hope that we don't overcorrect on that front.
I think that's a good place to end this conversation. Again, everybody, please make sure you follow Matthew Klein. Check out The Overshoot, his website. This will be a podcast on all your favorite platforms. Enjoy the holidays, everybody, and we'll see you next time. Thank you, Matthew.